But I'd like to yield some additional time to Mr. Barr, my friend and colleague from Kentucky.
Thank you, Mr. Budd. My friend from Georgia asked, I think, an important question to Mr. Nini about the relative size of the U.S. leveraged loan market compared to the investment-grade bond market, the mortgage debt market, the overall fixed income market. And the numbers, just to share for the record, according to the securities industry, is that, as you said, 1.7, 1.8 trillion is the leveraged loans outstanding today. My understanding is that the entire U.S. fixed income market is around 42 trillion. So in terms of the relative size compared to the overall fixed income market, I think that's an important contextual fact that we need to keep in mind. Another point is that in the last quarter of 2018, the FANG stocks, 5 stocks, Facebook, Apple, Amazon, Netflix, and Google, during the volatility of December, lost over $630 billion in market cap, which obviously led to short-term losses and significant losses for their investors. But it did not spread across the entire financial system. And I think it's important to note that the losses in these 5 stocks in that one quarter amounts to more than 60% of the entire leveraged loan market. So, look, I don't think anybody's going to deny that there's risk in leveraged lending. Of course there's risk in leveraged lending. That's the whole point. And I don't think many people are going to deny that credit risk is actually increasing either. I think the issue here for the purposes of this hearing is whether or not that increased risk presents a systemic issue. And the point is, it's just not that significant it's an important part of the financing of great American job-producing companies. It creates dynamism in our economy, creates wages and jobs. It forestalls bankruptcies. It helps create efficiencies, but it is a relatively small slice of the entire U.S. economy from a systemic risk standpoint. I think that's an important point. Final point / question to anyone who wants to answer this. I have to note and observe that many of our colleagues who are expressing skepticism of leveraged lending here today are the very same members of Congress who are calling for a rollback of tax reform, corporate tax reform. They're the same colleagues who are calling for a rollback of the limitations on corporate interest deductibility. They're the same members of Congress who are calling for an increase in corporate income tax rates, which for leveraged but profitable companies doesn't seem to be like a very good idea for financial stability. I don't understand why we would be, if we are concerned about levered companies, why we would want to go back to the old tax code that incentivized less profit and more leverage. And I'd be happy to invite anyone to comment on that. Professor Gerning, I think you want to speak to that.
So the interest deduction for debt, it actually incentivizes more leverage by companies, both financial institutions and non-financial institutions. So I don't see that position as inconsistent at all.
So here's my question. Why would we want to make it harder on levered companies by increasing their taxes to the extent they have taxable liability? And I get it. Some highly levered companies may not have profits, but most of these companies have taxable profit, corporate profit. They may be levered, but they have. Why would we want to increase taxes? If we're concerned about leverage in the system, why would we want to make it harder on levered companies?
Because long-term, I think we should be reducing our dependence on debt. There are other capital markets, like equity markets, that companies can access to fund themselves. Long-term excessive reliance on debt, particularly debt by financial institutions, is destabilizing.
Well, making it harder on levered companies is not a good idea. I'll yield back.